Thank you, John. Our final presenter before we go out to Mr. Teeter's farm will be Dr. Darren Hudson. Dr. Hudson is the director of the Cotton Economics Research Institute at Texas Tech University. He holds the Larry Combest Chair for Agricultural Competitiveness. Dr. Hudson's background includes a Bachelor of Science degree from West Texas State, before the name change, and MS and PhD from Texas Tech University. We're glad to have Dr. Hudson here, and he will be visiting with you about the 2014 crop outlook. Thank you, Dr. Hudson.
All right, thank you. I'll be brief. I know y'all got a bus to catch and a field day to visit, so I'll be as quick as I possibly can, which is probably going to be easy because the story is pretty depressing. As most of you know who've been watching this. Before I get started, I do want to thank Mark Welch and John Robinson from Texas AgriLife Extension. We pool resources and try to share slides and do things for Outlook meetings. And so I've robbed quite a bit from them for this presentation. One of the things that we want to look at is, what a difference a year makes. So a year ago, we were looking at pretty extreme drought conditions. We've got better overall growing conditions now, a little bit wetter. And probably for the first time in several years, we've actually got enough subsoil moisture to plant a wheat crop. And that's a good thing. If we were at $8 or $9 wheat, it would be even better, but we're not there yet. Probably won't be there. And the other thing is that total demand is lower than we've seen in recent years. So I'll show you a couple of graphs. Overall demand for cotton hasn't recovered back to the pre-recession levels globally. And I will stress, I try to stress with crowds as we're thinking about this, cotton is not a local phenomenon. Cotton is very much a global phenomenon. High Plains, even though we are a substantial portion of the overall U.S. crop. But other food grains, feed grain demand is a little bit lower than it has been in recent years. Per capita use is up, which is good, but it is overall, total demand's a little bit lower, but we're also seeing good production. So when we look at the balance sheet of all the major commodities, what we're seeing here is a general trend towards building of stocks. I won't bore you with economic graphs, but the principle that we operate under is that high prices beget low prices. And so we've had a fairly long period of high prices. There was a significant time lag in terms of the stock building, but generally what happens when prices went up is that we start to accumulate stocks. That's a signal that there's going to be some hoarding taking place or stockpiling taking place in the near future. That's exactly what we're starting to see. And then we see the reaction, the usual reaction is a drop in prices following that. Cotton, if you look at sort of overall, the blue line represents the production globally. The red line represents the consumption. You can see the peak back here in 06, 07 in terms of global cotton use. We had that big run-up in price. Everybody remembers missing out on it, selling it at 70 and 80 cents and then going to $1.20, $1.30. And like John Robinson and I talked about for several weeks or several months after this was over, is that everybody was real excited, and we said, don't be too excited, because $1.20 cotton will destroy a lot of demand for cotton. And that's exactly what happened, is we saw a pretty substantial drop-off in use of cotton. We've seen a little bit of recovery lately, but it's certainly nowhere near where we were. Yet production is near or at all-time highs globally. We look at the U.S. this year, USDA revised upward significantly. Some people are now saying 17.5 to 18 million bales. Probably I'm more in the 17 to 17.5 million bales for the U.S. crop. I don't think our crop is as good as what USDA thinks it is at this point, but we're certainly going to be late. We've got a lot of risk in that. But we're producing a lot of cotton this year. India is producing a record crop. They had a great monsoon. Their production is exploding to all-time highs in India. So what we're seeing in terms of the prices today for cotton are a reflection of a couple of things. And we'll talk a little bit about those real quick. First of all is the red line represents the A index, or the world price for cotton, and you can see the spike that occurred and the drop off. We're still above long-term average for world prices, but you can see what's happening to the stocks-to-use ratio. And the last three are forecasted, the little pink dots there are forecasted, and so we're forecasting even more stocks relative to use in the coming years. So what we're looking at here is a pattern that's setting up for a lot of downside pressure on cotton price. Now, we've seen, where these levels of stocks, there's two different stock levels that we have to be concerned at. One of them is sort of the overall stocks. That's what this bar represents. But then there is stocks outside of China. And stocks outside of China are what the market has been largely reacting to over the last several years. We've sort of settled into a pattern that we think China, the stocks in China are locked in China and they're not going anywhere. And they're not going to dump them on the world market. And so therefore we've been operating at what's outside of China. Well, we were at sort of historic low levels for those stocks outside of China. But even those are starting to accumulate now. The U.S. is forecasted to have higher ending stocks, but other places like India are forecast to have higher ending stocks. So we're seeing this downward pressure on price. But China is obviously the 800-pound gorilla. So a couple of things that we need to be concerned about. I mean, this year's essentially in the books. We were in this quandary back in February and March. Were we going to get rain? If we would have known we were going to have rain, you should have sold your cotton. But it's a rational sort of hedging decision here to say, well, I'm not going to sell a lot of cotton forward because I don't want to get stuck holding the bag and not have any rain. And so we left a lot of our acres open for that reason. But now we're sitting here looking, staring at potential 55 cent cotton going into harvest, and we haven't sold a lot of it. So for us, this year's probably pretty close in the books. What we need to think about is the next several years, and the next several years are going to hinge largely on what happens in China. So what's happening in China right now is a shifting focus from stock accumulation to price supports. They were in a mode after the run-up in the prices, and they got caught essentially empty-handed with no cotton on hand and had to go out into the market and pay large premiums for that cotton to run their textile industry. They embarked on a stockpiling program. Now, for everybody in this room that grows cotton, that was great because that held our prices up at 85, 90 cents, but it was an artificial price level being held up there by those purchases. Now they're starting to withdraw out of that market and they're purchasing a lot less cotton. You see what's happening to our overall price level. So they're moving to this price support mechanism that resembles a lot like the old target price programs in the U.S. But what that means is that's likely smaller overall production because the price levels that they're talking about are not as competitive with grains as the stockpiling prices were, or the minimum support prices were under the stockpiling program. Mainly Western China is going to continue to grow cotton. It's profitable for them. It looks a lot like West Texas. It's high and dry and it does really well growing cotton. But the eastern provinces are likely to switch more to food and feed grains as a result of this shift in policy. The question is how is China going to unwind its stocks? Now, I don't know how many of you are aware of the scale of Chinese stocks, but right now we're at about 55 million bales of Chinese stocks. Total global annual use for cotton is around 115 million bales. So China has enough in stocks to satisfy half of the world's total demand without ever lifting a finger. They have enough to run their domestic textile industry for 2 years without buying another bale of foreign cotton. So that gives you an idea of the scale of their stockpile that they have. What are they going to do with it? Well, they'll slowly bleed this off, is what most people think. Because they have a lot of money invested in those stocks as well. They were buying them at $1.30, $1.20, $1.30 per pound. So they don't want to sell it off at 55 cents a pound if they can avoid it. But they'll bleed those stocks off over time, and we'll get a more rational response. But we're probably talking 5 years before we start to see any lifting of that burden that's created by those Chinese stocks. So China's not going to help us any, but it's certainly probably not going to cause a catastrophic failure in the cotton market. Where we're seeing right now, and Jay Yates and I we've talked about this before and said it publicly, is that if we were really trading on the total supply-demand situation in cotton right now, we would be at about 35 cents. So thank your lucky stars they're not dumping the market, and that people aren't reacting to total demand. They're believing that China's going to bleed these off in a rational way. So hopefully that'll continue. But what that does for us is it gives us a pretty dire outlook for the next couple of years in terms of overall price. John Robinson does this one. I think it's a great graph because if you look, the blue bars back here are what we call index funds. It's the fire and forget. They go out and they buy, and they're long, and they're only long. And so they're just out there buying these commodities as part of their overall portfolio. The green bars represent what we call hedge funds. Those are those that are going either long or short, depending on what they think the market is going to be. You can tell that the market, this red line, price moves pretty well with those hedge funds. So those hedge funds are moving in and out of the market. Well, where are they now? They've dropped completely out of the market, and they're net short now. The hedge funds are net short as opposed to being net long, and we see what's happened to overall price in the last few months. Hedge funds by themselves aren't necessarily bad animals, but what most people don't understand is that a hedge fund is used to sloshing around a couple $1 billion in the treasury market. You slosh around a couple $100 million in the cotton market, and you're going to move them because there's just not that many contracts out there. And so when they move it in and out, they do have a tendency to shift directions. But some people would argue that those hedge funds are signaling the underlying fundamentals because they are trading against fundamentals or their expectations about what's going to happen in the overall market. So hedge funds, if you think those guys on Wall Street are smarter than we are, they're saying short. So that means they're anticipating further downward price moves in the future. If we look at December futures, I looked this morning, it was about 63 to 64 cents. If you're around that 63, that implies a farm price to us at about 56 cents. That's nasty. We haven't seen that in a while, and that's not a good price to be trying to grow cotton at. It is. We'll see if we hang in that area. If you look at WASDE, the USDA forecast, they're forecasting an average farm price between 60 and 76 cents. We had ours at when we did back in January forecasting for this crop year. We had ours at about 64 for a farm level price. We're sort of sticking at that 64 cents. I don't think the underlying fundamentals have changed that much. But we do have a little added production compared to where we thought we were going to be at this point, because we were forecasting a little higher abandonment rate in West Texas than we ended up getting. But somewhere in that 60 to 65 cent range seems a fairly reasonable average farm price, U.S. farm price. But our farm price tends to be on the lower side of that average. So we may be in the high 50s before it's all said and done, especially right at harvest. That's not good news. I'll pick out corn here because we've got so many different grains and we don't have very much time. So I'm going to use corn as an example. Most of the grains are following a very similar pattern. They're not all the same, but they're following a fairly similar pattern. If you look at the green bars here, they represent days of use, or what's on hand versus what's being used. The long-term average here, the 20-year average is the blue bar. The 10-year average is the red bar. So the forecast for this year is somewhere in between the 10-year and 20-year average. But the critical thing there in terms of price movement is that we're going up in stocks, not down. So the upward movement in stocks is putting that downward pressure on price. We have a number of different factors that underlie that, especially for corn, because it's not just feed anymore. It is a major energy market, and so it's tied to that as well. So in the terms of the stock situation, we're looking, corn is in the same sort of scenario that cotton is. We've got extra production, over consumption. We're building stocks. It's putting downward pressure on price. If we look at the overall disappearance here, the red line represents production, blue is domestic use and exports. This black line represents the stocks to use ratio, and then down here are the ending stocks. But notice what the stocks to use ratio is doing. So as that stocks to use ratio is rising, that means that we've got more stocks on hand than we've had in the past, hence the downward pressure on price. But that's not the only thing that's driving price down, because obviously we're certainly not at any sort of historically high stocks to use ratio, but we are high relative to where we have been over the last 4 or 5 years, and that's really changed the dynamics in the market. If you look at the breakout here, this is where we get to see where the impact of the energy is. This red is the traditional feed residuals. The green is the exports. The black is the food or the seed and industrial use. So both the seed market and then sort of what goes to food markets. This blue is the fuel market. So you can see what's happened to the fuel market. We use as much corn for fuel as we do for feed and residual. And so that's how much influence the energy market has on the corn market. And then that in turn translates its way down on into other grain markets as well. So wheat, sorghum, other things that compete for the same acres at the same time. Now, probably one of the best signs here, at least if you're a livestock producer, is this uptick in the feed residual use. And I don't mean that, corn prices have come down, so it's a little cheaper to feed cattle, but you have to have more cattle. We've sort of maxed out at animal unit usage of feed grains. And so what you're really living off of now is if whatever kind of growth you're going to get in demand is going to be in total head numbers. And so if we can start to see some recovery in the head numbers, that plays a whole host of great economic news for this part of the world anyway. The fuel thing, I didn't put this slide in here because I didn't want to spend a lot of time on it. But we have a slide up here, or Mark gathers the data and puts this for ethanol profitability. And ethanol has been profitable as a standalone product now for several years. And so that's driving that consumption. But we've tapped out the domestic ethanol market. So unless we change the law, we've got declining fuel use in the U.S. We don't have a change in the blend ratios, or we haven't had a major change in the blend ratios. And so our market for ethanol has been exports. We've exported a lot of ethanol to Brazil, of all places. It's kind of transitional. Theirs is driven by sugar prices, and then ours, so they backfill with our ethanol. So ethanol has been fairly profitable, but that profit margin is collapsing. And so it's getting now back down to where there's a little less profit in ethanol. So we may see a little less offtake of corn for ethanol use in the years to come. If you look down here, I know it's hard to see. I try to copy this spreadsheet, but this is the balance sheet. And this number right here is what I was talking about. Ethanol is about 36% of overall corn use now in this year's balance sheet. If you look at the supply-demand situation, based on trend yield, we were a little higher than trend yield last year. If we stay on trend yield this year, what we're going to end up with is a price somewhere between $3.55 and $4.25. And Mark has his midpoint or his estimate at $3.90. We're a little lower than that on futures at this point. So I don't know if we're going to meet that price expectation. We may be a little off. Big story here, though, is that going out into the future, there's not a lot of upside price risk in any of these markets. So don't be sitting around waiting for price to rebound to $5.50 a bushel. It's just not in the cards unless we have a weather event. Okay, so we could still have weather events. This is, one of these nasty charts. This is corn. You can see where we were through the year. We had a rally, and then the bottom fell out. We're down in the 350 to 370 range, and so we're well into that less than cost of production range at this point. So we're pushing cash costs now. We're below economic returns, and we're getting into cash costs, just covering those. So wrap this up real quick so we get on with the rest of the program. I think we're entering a period, and this is not great news for everybody in this room, but we're entering a period where the real price signals are much lower, more stable, but much lower than they have been historically. And so we've got to plan for those kinds of returns in the future. Weather events will still play an important role. Right now, though, in cotton, you could wipe out the entire West Texas crop and there would be no impact on cotton price. None. So don't count on your neighbors going out of losing their crop and then thinking you're going to recover a little in the price. That's not going to happen. Corn, on the other hand, is still fairly weather sensitive. So if we have a major event in the Midwest that knocks corn yields, we could see a pretty substantial rise in price. But one thing that we have to remember about corn is U.S. used to be the dominant producer of corn globally. And as a country, we still are. But the rest of the world now produces more corn than we do. So it's becoming a much more international driven situation as well. So weather could still play a role, could still be important. Pre-season and in-season marketing are going to take on new importance. So Jackie's job is more complicated now than it was several years ago. And better weather conditions for now. So hopefully we'll persist with this and at least have the ability to grow a crop. I don't know if it's going to be worth anything, but we'll at least have the ability to grow a crop. I will add one thing that Jackie said about the Farm Bill and the Farm Bill calculators, just as a point of reference for you all in this room. I, Joe, Jackie, there's a big group that is working on this information, and we're working with FSA. We were supposed to have an organizational meeting early August to get started. FSA called Joe and said, don't bother. We won't have anything for you. So I'm keeping my fingers crossed that you can be looking at these calculators and finished and starting to think about making decisions about farm bills as you're eating turkey at Thanksgiving. We might be lucky if we get it done there. So with that, I'll stop. I know I've depressed everybody. You can go now out in the field and have some fun. Any questions? All right.